Welcome to part 2 of the video series on donor advised funds. This is part of the bigger series on charitable giving and tax planning strategies surrounding charitable giving. In the last video, we introduced the general concept of a donor advised fund. We talked about some of the advantages. And in this video, we're going to start out talking about some of the disadvantages, and then we'll get into a little bit more detail, some limitations, restrictions, and just general things that you should know about if you're considering making a contribution into a donor advised fund. One disadvantage is that the sponsoring organizations charge fees. This makes sense. They're managing money, so they're going to charge fees, and it's still often a more cost-effective alternative compared to a private foundation. But it's just a point to understand that if you're making direct contributions to the charity of your choice, you're not going to pay any fees for that. But if you want to use a donor advised fund to get you over the hump of the standard deduction and get the preferential tax treatment associated with itemizing your contributions, then it's just something that you have to give up in order to get that benefit. One of the strange disadvantages of a donor advised fund, or potential disadvantages, is that the fund is not required to follow the advice or the suggestion as to how the assets are distributed by the donor. And you might ask, what? As strange as that sounds, that's how donor advised funds work, and they're set up that way for a reason. If the donor retained complete control over the contribution, it could run afoul of the rules and lose the benefit of receiving a tax deduction in a single taxable year. But you can imagine that the fund may not attract donors if they are routinely ignoring donor suggestions. So you can pretty well bet that the sponsoring organizations are generally following the guidance of the donors. So as a practical matter, this isn't generally perceived as a big concern. It's just something interesting to know about. And I guess there could potentially come a time where for some reason the sponsoring organization would tell you no. I have not heard of that happening. So again, I don't think it's a big concern, but just something, an interesting point. Another disadvantage is there may be limited investment options. So each sponsoring organization is going to have its favored investment options. And so whatever fund you are creating, or whoever the sponsoring organization is for that fund, may have certain limitations on investment options. Another potential disadvantage, depending on what your individual goals are, is that distributions cannot be made to private foundations. Finally, there may be restrictions on the type of property that can be contributed to a DAF, or at least the individual fund managers may regulate how they deal with certain assets. So if you have hard to value assets, sometimes people want to contribute real estate or personal property, there may be some issues associated with that. So you'll just want to consider what type of property you're interested in contributing and do some research. Talk to some of the sponsoring organizations or representatives from the sponsoring organizations, and you can work through some of those details. So what are the takeaways? One, DAFs offer donors flexibility similar to what they might have with private foundations in terms of how and when distributions are made. Two, donors get the full charitable deduction in a single taxable year when the contributions are made to the fund. And three, there's less regulatory oversight compared to private foundations. There is some criticism over DAFs. Some argue that they result in less money going to charities from large donors who would otherwise make an immediate impact with their contributions. Instead, these donors are putting large contributions into the funds, and then the assets stay there for years without being allocated for charitable purposes. Now, the assumption is, on the other hand, that the funds are ultimately going to charities. At some point, they have to. Otherwise, the IRS wouldn't allow you to take the tax deduction. But the point is well made. In the first video, we talked about Fidelity Charitable managing $48 billion. There's an argument to be made that that money would otherwise be going directly to the charities, and as a result of the rules that allow contributions to go into DAFs and be distributed over a period of time, prevent those assets going to the charities at the time that they're initially contributed. So whether or not you have an opinion on this, or as a matter of public policy, they make sense or don't make sense, that's up to you and up to the powers that be to decide. But it's just an interesting observation. It's interesting to hear some of the criticism and some of the arguments on either side. Now let's talk about some of the use cases of a DAF. So in one of our earlier videos, we talked about the concept of bunching, and that's really how these tools work. So the concept of bunching, if you remember, just a quick review, is the idea that we may not get preferential tax treatment through our charitable contributions unless we are itemizing deductions. If we're taking the standard deduction in a given tax year that we've made a charitable contribution, there's a real good chance that we may not receive any tax benefit whatsoever from that contribution. Now, we'll talk in other videos, and we've talked previously about gifting highly appreciated assets, so there could be some tax benefit there. But generally speaking, and for the purposes of this video to describe how DAFs work, they're used in conjunction together with the concept of bunching. So you take a larger contribution, you make it into a donor advised fund in a single taxable year. You get the benefit as long as your contributions in conjunction with your other itemized deductions exceed the standard deduction. But then you get the benefit of making distributions from the fund over a period of years. So one of the criticisms or concerns with the concept of bunching to begin with is that it can prevent somebody who's charitably minded from making regular contributions and seeing the consistent impact of their contributions. These tools allow you to address that problem. So you make the contribution into the donor advised fund, you get the tax benefit of your contribution, but then you also have the benefit of being able, if you want, to make regular distributions to the charities of your choice. Kind of along those same lines, the contribution can be made in a year where you have abnormally high income. So this might kick you into a higher income tax bracket, or you just may want to reduce the amount of taxable income that you're going to pay tax on. So you could make the contribution into the fund, and in the same tax year where you might have a high income earning year, you can offset the income through your contribution into the DAF. Another use case is that you can make a contribution into a DAF in the same taxable year as a Roth IRA conversion. So I'm not going to go too much into this topic, but generally speaking, there are opportunities for traditional simple SEP IRAs to be converted into a Roth IRA. And in the year that that conversion is made, you may have a potentially significant amount of income that's generated as a result of the conversion that you're going to have to pay tax on. So if you have that as an idea that you may want to consider, you can offset that income in the tax year that you make a contribution into a DAF. Another use case is making the contribution to a DAF in a year where you've sold highly appreciated assets and you're otherwise going to have a significant capital gains tax consequence. The contribution into a DAF can be used to offset the otherwise potentially significant tax burden associated with those transfers. And so again, just something to think about, another use case for contributions into a DAF. Now, there is a potential for a double tax benefit So gifting highly appreciated assets into a DAF could result in an immediate tax deduction of the fair market value of the asset, with potential limitations, which we'll talk about in a moment, plus avoidance of capital gains tax that would have resulted from a sale of the asset. And so this is really a wonderful tax result, but we have to be aware of limitations. So charitable deductions for cash contributions cannot be greater than 60% of the taxpayer's adjusted gross income. Now that's in 2024. But in some cases, limits of 50%, 30%, or even 20% may apply. So for example, for non-cash assets, deductions are limited to 50% of adjusted gross income if you use the basis as the value for the deduction, or 30% of adjusted gross income if you use the fair market value as the value for determining the deduction. Now, this really is a straightforward math problem, but it is extremely important to run the numbers. It's also important to make sure that you're using current figures. The limits we're discussing are always subject to change, so please make sure that you're using current figures in your analysis. So what this means is that you'll want to be mindful of making substantial contributions in low-income years if your goal is to take full advantage of the tax benefits of your generosity. And as a final note, if you exceed the limitations that we just outlined, contributions that exceed the adjusted gross income limits can be carried over for the following 5 years. So you don't necessarily lose your deduction if you exceed the adjusted gross income limits. I just want to end by highlighting how impactful, thoughtful giving can be for you and ultimately for the charitable organizations who only exist because of your generosity and the generosity of others. If you are interested in making the most of your charitable giving, I highly recommend that you speak with an accountant or with an estate planning attorney to help you evaluate all of your options. If you like this content, please let me know. Please consider subscribing to the channel so that you can stay tuned through the rest of this series, and we'll look forward to seeing you in the next episode.